everyone. I'm Sarah Swan, Vice President and Wealth Manager at Howe and Rusling. In today's Street Smarts, I'm hoping to give you a better understanding of annuities. Annuities are insurance products that are often sold to people as really critical tools for retirement planning, offering a reliable income stream in retirement in exchange for a lump sum or periodic payments. These can be bought with IRA money to be considered qualified, or after-tax funds, non-qualified, and there is no limit to how much money you can put into an annuity. I'm going to delve into how annuities work, revealing how they are different and pros and cons to consider before buying one. So firstly, an annuity is an insurance product that you must have a license to sell to a person. At Howe and Rusling, we do not sell annuities to our clients. If I did sell an annuity to my client, you could expect me to make as much as 6% or 8% or more in commission on each annuity sold. That's a pretty hefty incentive to try to corral people into annuities. Now that commission may not be felt directly by you, as it would be paid to me by the insurance company. But I think it's important to consider what incentives I might have in selling you that annuity. However, other fees the annuitant does pay going forward, some of which they may not even realize they're paying. Mortality and expense, or M&E fees, cover insurance costs and administrative expenses. Investment management and administrative fees are charged for managing the investments and handling the administrative tasks. Rider fees are additional charges for optional features, such as a guaranteed minimum income. And then lastly, surrender charges. These are typically sizable charges that are imposed for the first 5 to 7 years to discourage early withdrawals or premature access to funds. Surrender charges normally decrease the closer you actually come to the end of the period. Suffice it to say, there are a lot of fees, and they can total anywhere from 3 to 5% or more annually, not including that surrender fee I just talked about. And importantly, these various fees can erode your returns, impacting the overall value of the annuity, unbeknownst to the annuitant. There are many different types of annuities, but the most common ones we see are fixed deferred annuities and variable deferred annuities. The deferred part simply means that they will pay income to you in the future, as opposed to making payments to you right away. But fixed versus variable is an important distinction. Fixed annuities offer a guaranteed interest rate for a specific period, providing predictable, steady income. Typically, a more attractive, guaranteed rate of return might be offered for the first year or so, but then it's reduced after that, kind of like a teaser rate. From that point on, then, you'd be stuck with the same lower return, unless, of course, you surrendered the policy. And it's usually a rate on par or lower even than a rate you could achieve with a conservative bond portfolio. Variable deferred annuities, on the other hand, are a very different animal in that they offer the ability to grow from the fact that they are exposed to stock market fluctuations. So they therefore offer a higher potential rate of return than fixed annuities. These products are really appealing to people because they offer a combination of growth upside, but also a guaranteed income stream. But oddly, we would say that these are the annuity products that we are most typically skeptical of. Now let's get into the pros and cons to consider for annuities, and again, particularly variable annuities. If you were to read a list of pros about them, you might find a few, including maybe their tax-deferred nature or their death benefits, but the most differentiating pro that is truly unique to annuities, as opposed to a simple traditional IRA, for instance, is the fact that they pay a guaranteed, steady stream of income. The key word there, of course, being guaranteed, because annuities are insurance contracts. They're not really investment products. Therefore, they can promise either a guaranteed stream of income or a minimum guaranteed account value, whereas traditional investment products, of course, can't. Even though, historically speaking, over long periods, the stock market has been reliable in producing both growth and income, it's never a guarantee in the sense that the stock market naturally fluctuates. The guaranteed part of annuities is a legitimate differentiator, especially if you're fairly certain you're going to run out of money in retirement. However, of course, the guaranteed part of annuities is also what makes them really expensive. You're paying for that guarantee. Annuities are insurance products, and insurance companies assume the risk of providing income payments to people for life. They have to protect themselves against the guarantees they make by charging enough in fees to make it worth their while to pay out guaranteed income for life. So clearly, that's the first con that I want to make known. These products are sneaky expensive. As a general rule of thumb, the better the product sounds or the more it offers or protects against, the more you will probably pay in fees, eroding your overall value over time. Now, hopefully it's also clear at this point that annuities are complex beasts. At Howe and Rusling, we're a bit skeptical of any investment or contract that would come with 60 pages of fine print. Annuities fit this bill. They're confusing and they're sold to people for a commission, which usually means much can be unclear or misleading for folks who are not experts in this stuff. So moving on, let's consider their poor tax treatment in the annuitant's lifetime and upon their death. So distributions from annuities are taxed as ordinary income, whether in a qualified or IRA annuity or non-qualified funded with after-tax dollars. This is different from an investment in stocks inside of an after-tax brokerage account, in which long-term growth is taxed at capital gains rates, which are lower than ordinary income tax rates. Also, unlike stocks in a brokerage account, the cost basis of variable annuities doesn't step up to the date of death when they are inherited. Beneficiaries will pay tax on the entire contract value that has grown from the date that the annuity was initially purchased. Next, let's talk about the lack of liquidity or flexibility there. All annuities have an accumulation period and a withdrawal period. The accumulation time begins when you purchase the policy. Your account balance will grow at the either fixed or variable rate, and when you decide to take the income from the policy, the accumulation period ends and the withdrawal period begins. During the accumulation period, you have some flexibility to get out of the policy, right? You might pay a surrender charge or early withdrawal penalty for the first several years. Once you begin the withdrawal period, though, you typically don't have the same flexibility to get out of the policy and get all of your money back if you really needed it. As insurance products with riders, these things can come with various bells, whistles, rules, plenty of fine print, as we've covered. If you're even remotely considering buying one of these things or you're curious about one you maybe already own, I would encourage you to bring the prospectus to your advisor. I typically call the company with my client on the phone to ask lots of direct questions about the annuity itself to make sure that we understand all of these factors before offering our advice about it. Our clients frequently come to us with annuities that they've been sold in the past, and I'd honestly say that the vast majority of time, we're enlightening the person about how that annuity actually works, how much they're giving away in costly fees each year, and just how much better off they would have been simply investing their IRA or their brokerage account in a balanced portfolio of stocks and bonds with very good liquidity, lower fees, to participate in long-term market growth that does outpace inflation. If our financial planning modeling revealed that you can most likely afford to withdraw 5% of your investment portfolio every year without running out of money someday, and without paying 3 to 5% in annuity fees every year, is that guaranteed part of the annuity still as appealing to you? We know it's a mindset shift for sure, but one that we really would encourage you to consider before putting your money into an annuity. Every situation is different, of course, but most often when we run calculations for people on whether holding an annuity makes sense, we really recommend simply investing in a balanced portfolio of stocks and bonds instead, and letting the natural long-term growth of the market run its course. Thank you for watching today's Street Smarts. If you have questions that weren't covered today, please don't hesitate to reach out to us.